emerging markets, equity opportunities. We've been talking about this subject at great length within our firm for the past few months. And as you know, we did a webinar a month or so ago that talked about the global debt market and particularly emerging market opportunities. So this time we have Moneem Salam, who's an executive vice president and the portfolio manager for the Amana Developing World Fund, among other strategies he runs for the firm, and Levi Zerbrug, who you recall was a key contributor and developer of our Amana Impact Report, which this time, the 2020 report, included information about the Developing World Fund and how we achieve impact in that strategy. So this is Craig Sherman. I welcome you to our call again and look forward to the discussion. Emerging market investment opportunities have been both interesting and curious and challenging over the last few years. And Moneem and Levi will both share some of their insights really from the last couple of years, and even looking back 10 years, the strategy we run has been run for 11 years or so. And it's done very well. Moneem and Levi and Scott Klimo had a really good last half of the year, and that fund's performed well. Not surprised because it's been front of mind. The Amana Developing World Fund was developed in 2009, and Moneem took it over as the full portfolio manager about a year ago. So I'd like to introduce Moneem and let him talk a little bit about the strategy that we run as we tee up some other conversations that'll include the dollar and the strength and weakness of the dollar, and maybe topics around China, which when you're talking about EM is top of mind with a lot of our clients. Thank you, Moneem.
Yeah. Thank you, Craig. And thank you everyone for joining the conversation. I just wanted to kind of give you a little bit of a brief highlight on the fund itself. We do have a retail class and institutional class. We started the Developing World Fund back in 2009, just as a diversification tool for the Amana Fund family that we had. At that time, we only had the growth and the income fund. And we had, although the growth income fund are allowed to have a little bit of exposure outside the US as being developed world, really taking advantage of the emerging markets was somewhere we felt in the long run, it would actually work out really well. But, timing is everything. So the last decade or so, the emerging markets really haven't gone anywhere, pretty much been flat on an annual basis. But I do feel, and we'll get into this a little bit more, there are certain trends that are happening now that I feel, or we feel actually, that will show that the next decade is probably going to be very similar to what happened in the first decade of this century. Which, like I said, so established in 2009, portfolio managers. Scott Klimo ran the fund for a very long time. When I went to Malaysia, and then when I came back 2 years ago, I took over last year. And then Levi also provides good complementary services. I mean, he knows the emerging markets and also the ESG space really well. It is a Sharia compliant fund, and so there is the idea that we're staying away from the sin stocks, so we don't and get involved in anything dealing with alcohol or tobacco, gambling, pork products, insurance, those things, and the other thing is that we also have financial ratios that we that we keep, and then thirdly, it's also the ESG criteria, and the ESG criteria not only look at the negative side of it, which it's kind of complementary to the Islamic side, but also there are positive screens that we look at, and here Levi will talk a little bit in more detail later on in the presentation, but we're looking for strong performers, when it comes to recycling, when it comes to resource efficiencies, production of greenhouse gases, community, labor relations, safety, and then on the G side, board diversity, business ethics, and those things as well. And so those are the types of things we look at, along with, it's an integrated process when an analyst actually looks at the companies. So it's not only about the fundamentals, but it's also about the Sharia and the ESG criteria as well. One of the unique features about our fund also is that we're able to invest in companies no matter where they are traded in the world, as long as over 50% of either their production assets or revenues come from developing countries. So if you look at the holdings in the Amana Developing World, you will find companies that are domiciled in the US, traded in the US. But when you dig a little bit deeper, you realize that either through exposure into Asia or other countries or other emerging market countries, they have a significant amount of either revenues or production assets in emerging markets. So we're able to take advantage of that as well from there. And then the last thing that I wanted to mention regarding just one of the unique features of the fund is that we don't have a very heavy China exposure. And actually, we don't have any direct exposure into China when it comes to trading on the Shenzhen or any other markets in China itself. So how we access China is through Hong Kong and through ADRs in the US. And we made a call that, especially when it comes to governance, there's a lot of opaqueness in China, especially for those companies that are trading only in China itself. However, the depth of the market in the U.S., obviously with regulations, has at a higher standard, and so is Hong Kong. Hong Kong is one of the developed markets, and is something that the regulations are very, very strong when it comes to governance, reporting, accounting, those type of things. So that's kind of giving you just a little bit of an idea of the features of the fund. We are, as Craig alluded to in the beginning, very bullish in the next coming decade for the Amana developing world. Yeah, go ahead.
And Moneem, we don't really track benchmark. We're not really benchmark managers. And one of the discussions we've had in the past is there was a heavy weighting in some of the countries toward traditional financial institutions. But I think you've been able to find some other financial institutions because we have more of a weighting in finance compared to some of the other Amana funds. And we can talk about that later.
I can just mention quickly. So there's traditionally in the emerging markets, there've been, the largest companies with the largest market cap and liquidity have always been in 4 different industries. There was a bank, there was an insurance company, there was a telecommunication company, and usually a natural resource like a fossil fuel company, oil and gas exploration. So if you look at it from the Amana perspective, so banks would be out, insurance would be out because of the riba reasons. Typically, the telecommunications would be out, not always, but typically would be out because of debt. And then the last one, which is oil and gas, because we're fossil fuel free, that would be out as well. So then where do you turn to do that? So that was one of the factors we looked at, but luckily, and we'll talk about this later, but there has been a shift in emerging markets as to what the dominant industries are. What helps also in our space is that there are now more Islamic banks that are actually trading publicly, whether they be in GCC, the Gulf Cooperation Council in the Arab world, in Malaysia, in Indonesia. There are more opportunities for us to have exposure into financials that we probably didn't even have 10 years ago.
Yeah, and I would also add that you were in Malaysia for 6 years, so you got a lot of firsthand experience in the melding of Islamic finance and ESG, and also visiting those countries and companies where we found investment opportunities that you've been able to parlay into this fund now. So
correct. Yeah, it's been really exciting. It was an exciting time for me to be there to learn and really, I guess in hindsight, prepare myself for coming back and doing the Developing World Fund. There's a lot of issues when it comes, a lot of understanding you have to have when it comes to culture, when it comes to how companies trade and how liquid the markets are. Sometimes it can be very deceptive.
Okay, and then the next slide, you'll go into this in more detail, but we shared some of this when we were talking about our global bond strategies and how we were really bullish on the emerging market in certain areas.
So I mean, what I wanted to kind of do is, if you look at the market capitalization, by country, you're going to find that the U.S. is going to be the dominant player when it comes to global. However, in the landscape, when you're looking out, in the long run, 10 years, 20 years, 30 years down the road, there is a significant shift that's actually happening when it comes to the largest economies, when it comes to GDP in the next few years. So on the slide, on the right-hand side of the slide, what you'll find is the top 10 in 2016, the top 10 largest economies in the world. And then if you look at in 2050, what the projections are, you're going to find that what I've highlighted in red are the ones that are coming down, meaning they're becoming smaller as far as GDP production. And then the black ones are staying the same, but then the green ones are the ones that are increasing in their GDP. Now, one thing to keep in mind, this is not, in my opinion, a zero-sum game. So, a rising tide, which is the global economy, is going to lift all boats. So it's not that US or like Japan or Germany or UK will have negative growth, growth rates, and so that's why these other countries are doing better. It's just more a matter of, these companies are just having higher growth rates. So, for example, minus last year, Indonesia was averaging roughly about a 4.5% GDP growth rate, right? And so, if you compare that to the US at about 1.5 to 2%, X last year, I mean, that's a significant amount of growth, and a much faster way for Indonesia and also China to be able to catch up in India as well. So it's not really a matter of the ones in red are going to do poorly. It's more a matter of that the emerging markets are just going to do better than the rest of the world. So on the relative basis, and that's why there has to be exposure there. And then the other thing is that what the emerging markets allow you to do is they allow you to have a non-US dollar exposure, right? And again, in this particular case, it's not a matter of the dollar is going to it's going to lose value considerably into nothing, which a lot of people sometimes talk about. It's more a matter of just the growth in the emerging markets will cause their currencies to strengthen, even if the dollar stays the same. But it's important to keep the dollar in mind. And so what we've done here in this slide is kind of take a look at just over a 10-year period, what the dollar has done relative to our fund. And what you'll find, which is normal and expected, but we wanted to be able to show it, is that as the dollar does well, the fund underperforms relative to the dollar, and then the opposite is true as well. And so just wanted to kind of show that. So it is a good play on having non-US dollar assets in your asset portfolio mix.
And then tying back to the last slide, the allocation that we have, you'd recommend something in the neighborhood of 5, 10, even 15%, because 15% of the equity opportunities are in that market. So we've been both strong on the EM, but actually encouraging our clients to do a stronger allocation, and that paid off well for clients last year.
But roughly 10 to 15% is usually what I would what's a good recommendation for an allocation. There's a lot of companies in the US that have global exposure, and so you invest in the S&P 500, and they're majority of the companies in the S&P 500 have more than 50% of their assets in non-US revenues coming from outside the US, and so you're going to get that exposure anyway. But this is even a deeper dive into being able to get exposure into not just global but specifically emerging markets.
So we'll turn it over to Levi now, and just you recall that Levi was one of the producers of our Amana Impact Report, and we had a webinar specifically on that. So we'll take a deeper look into how the Developing World Fund compares to the benchmark and how it compares in some of the categories we were used for screening in ESG. Thank you, Levi, for joining us.
Yeah, thanks, Craig, for the opportunity, and thanks to everyone for joining us on this webinar. We see ESG as an opportunity in the EM space and in the developing world, because the performance on ESG really helps to highlight the strength of management and management's commitment to sustainability. So in the developing world, where regulatory oversight can vary widely depending on jurisdiction, ESG gives us a better compass to understand how companies are actually performing regardless of varying regulations. And implementing this approach is something that we had done previous to last year when we added the Developing World Fund to our impact report. But we thought the impact report and the metrics were at a point where it was important for us to communicate that information to investors so that they can see how this process really plays out and how integrating ESG considerations into the Developing World Fund has actually really led to some strong performance in terms of various ESG factors. So 2 examples that we consider just at a high level are greenhouse gas emissions and renewable energy and board diversity. In terms of climate change, we look at greenhouse gas emissions and renewable energy, 2 commonly reported metrics. And the graph on the left-hand side shows you that the fund holdings have a higher average consumption of renewable energy. But what's really impressive, we think, is the 64% reduction in average greenhouse gas emissions that the Developing World Fund has compared to its benchmark.
You know, Levi, this is one of my favorite slides because I think the chart on the left really demonstrates why you would be an active manager, why you would underweight China, and then why you would end up with a much smaller carbon footprint. So in order for us to achieve impact, I think this slide makes that case very strongly. So thanks for doing this.
Yeah, my pleasure. I think the case has been made for ESG globally, but it's especially interesting in the developing world, again, where companies may be newer, there may not have been as much investor oversight, and it really gives us an added lens to understand management and management's ability to deliver on targets and while addressing social and environmental concerns.
And then on board diversity, obviously in other markets, it's maybe a different challenge than it would be in the US, but I think you have some strong metrics here also.
Yeah. So the board diversity is still, not quite to where we see in the S&P 500. It's below that, but I think it's telling to see the difference, whether that be independent board directors, which lend that independent perspective. And that's really what we're trying to get at with board diversity is having a diversity in thought. We believe that companies that have that diversity in thought are going to be more well adapted to deal with risks as they arise and highlight opportunities before those that may not. And so these metrics are a demonstration that the Developing World Fund tends to have, a higher percentage in both independent and female directors. And when it comes to the number of women in on the board, we see both the fund and benchmark are short of what's become known as the power of three threshold. And that's where research has shown that boards with three or more women are inclined to incorporate underrepresented viewpoints. So it's something that we're continuing looking for to see progress. And another area that we see less well disclosed in terms of quantitative metrics, but is cultural or ethnic diversity, and that's something that we're paying attention to as well, and would expect to see improved disclosure on in the future.
When we talk about board diversity, and speaking to the idea of active management, I mean, you can easily have a screen that shows that yes, we do have as a passive indexer, screen that shows you have women on the board, but digging a little bit deeper, you might realize that it's the founder's mom, wife, and daughter, and so that's not going to show up if you just do if you don't do an active search for what's really going on in the board. That's one part of it. And then the other part of it that kind of speaks to a little bit of cultural sensitivities. When we talk about board diversity in the US, there's a lot of times you talk about, having African Americans and other represented minorities on the board itself. You go to places in some countries where 95% of the population is of one ethnic group. So how do you define board diversity also is a question that we ask ourselves very often as well.
Mm-hmm. Which is going to vary.
Yeah. I think that's a great point. There's so much more to board diversity than these headline metrics, and these are very much a starting point. After this, we dig into each one of those board members and we look at what's their previous history, what's their expertise, what are their relationships. Sometimes a board member may seem independent, but maybe they worked previously with the CEO. So there's a lot that's lost if you limit yourself to just the headline metrics, but they provide more of a starting point than an endpoint for us.
And now you're going to move on to tell the story of Delta Electronics, which is one of the case studies that we highlighted. If you have a copy of the Amana Impact Report, and feel free to ask us for a copy, or we'll send you one after the webinar. And Delta Electronics is one of the case studies that we highlight on page 9 of that report.
Yeah, and as we were kind of alluding to or speaking about with board diversity, similar with portfolio metrics, it's interesting to see how the fund performs at a portfolio level, but I think looking at these case studies gives you a better understanding of what the initiatives companies have implemented look like, and just a little bit more of a tangible feel to how ESG plays out. And Delta Electronics is a great example of the trend that Moneem was speaking to earlier in terms of the developing world moving from a resource or extractive-based economy to a much more technologically advanced economy. So Delta Electronics is a provider of thermal and power management solutions. And basically what that means is they produce inductors which allow various electronics to use the appropriate wattage or voltage of electricity. And their mission statement is to provide innovative, clean, energy efficient solutions for a better tomorrow. So just that mission statement alone, I think is telling in terms of how they're positioning themselves to be a real leader in climate change and the transition to a low carbon economy. But one other area that we think that they've shown impressive improvement in their performance is regarding water use. So Delta recognizes that this is another important aspect of managing its environmental footprint. And as part of its management systems, the company maps water stress in the regions where it operates, and then incorporates climate models to understand how risks may develop going forward. So unlike climate change, water is more of a local issue. In some places there's not enough water, in others there's too much. And so allowing the company to understand its water risks in the context of local circumstances is really powerful. And sorry, go on, Craig.
Yeah, and in the report, you also give an update on Taiwan Semiconductor, another firm that has water as a major part of its business model, and how they're doing in terms of managing that dear resource.
Yeah, exactly. So we wanted to show, and those, for one, we wanted to show an update on what the companies we looked at last year for our report, because this is an evolutionary process. It's not just to say, well, Taiwan Semi did great in 2019, but worse in 2020. We want to compare that, make sure that this isn't stagnant. And what we actually saw was Taiwan Semi has continued to perform really well. And they added another lens to water. So whereas Delta has a focus on, it's a robust system, but the headline metrics that they're looking at are water use intensity. So not consuming too much water per unit of output. And they've done well to reduce that. One of the areas that's important for Taiwan Semi is to reduce pollution. So semiconductor manufacturing actually requires very pure water, but can produce quite a lot of pollutants, and in particular ammonia is one of the common pollutants. And Taiwan Semi has been able to reduce that the pollution of ammonia, or the production of ammonia, by 89% since 2018. So we see that they're continuing to move forward and progress their abilities to reduce water pollution.
Okay, and now we're going to move on and talk a little bit more about the fund itself. And any questions from the audience, feel free to bring it up. I think we shared our top 10 holdings, and the 1-year performance numbers, as you can see, up till the end of last year, the fund had a really good year and a really good fourth quarter. So thank you, Moneem and Levi and Scott Klimo, for that. If there's any questions from the group, we'll take it now. Moneem, one of the questions I wanted to ask you was, when you went to KL, we were a traditional manager with Islamic screens and negative screens. And you were able, over that time, particularly as our firm started to incorporate more positive in ESG, you found that the clients in that market and the institutions really loved the integration of ESG and Islamic finance. And you said, do you feel the same thing in the States? And what was your experience in terms of sharing our ESG story as you were, marketing in Asia?
Yeah, I think, if you look at the number of, UNPRI signatories in Asia, you're going to find, for obvious reasons, the majority of them being in Japan, Hong Kong, and Australia. However, there has been, over the period of, let's say, even the past 5 years, much growing interest in fund owners finding out what ESG, in doing a deeper dive into what ESG is, how can it actually impact their portfolios, and specifically in Malaysia itself, they've had a lot of fund owners have actually signed up to the UNPRI and begun to implement ESG strategies, eventually to be able to have their entire portfolio done that way. In some countries, actually, because it's in the emerging markets, it's usually a top-down, meaning the government has an initiative and then everybody follows along. And so in some countries, they've actually made it a priority, either through tax incentives or other ways for not only investors to be able to invest in ESG funds that might have a tax advantage, or fund owners, large institutions that make it advantageous for fund managers to be able to move much more towards the ESG space. So that's happening a lot, in Asia as well from there. So I think that's really an important highlight. It's not only happening in the fund management space, but also in the banking and insurance area as well, where the governments are becoming much more restrictive on how much a bank can actually have in their portfolio of companies, for example, that are doing exploration into oil and gas versus solar power, wind power, those type of things.
Okay, so here's a question we got in with the Chinese government interfering with Alibaba. There's talks of that also happening with Tencent. Is that a concern you have, or how are you following that money?
So we are following that, quite closely. So there's a couple of things happening with Alibaba. The first one is that you have to keep in mind now the cultural norms. The Communist Party is not going to allow a citizen to become more powerful or more influential than the premier. Okay, and one of the ways, and this I think was more for Alibaba, was a case that I think that Jack Ma just kind of overstepped his comfort zone and began to speak negatively about the authorities, especially when it comes to regulatory authorities in China, and that's a big no-no. So for that reason, I think they were. That was the start of the repercussions that took place. Now, that being said, yes, Tencent, Alibaba have been able to kind of skirt a little bit of the financial regulations by really being a technology company and not financial institution. That being said, I do think that that the Chinese government is going to be a little bit more lenient on companies like Tencent versus Alibaba, only because of the fact that of what Jack Ma specifically did. And why I say that is because after that event happened and he went to go meet with the regulators, you haven't really heard from him for a very long time, right? That speaks to a lot about what they're trying to rein in a personality, not just a company itself.
Okay, thanks for the question. I appreciate that. Any other closing remarks from Levi or Moneem?
Yeah, I just wanted to highlight one thing. I just want to circle back, and I told you about the 4 major industries, maybe about 10, 15 years ago, that would have shown up in an emerging market fund. The 2 areas that I think that you're finding a lot more opportunities in are going to be technology, as Levi mentioned, but then also consumer goods, whether they be discretionary or staples as well. And so if you look at our top 10 holdings, you do find companies like LG Household in there. That's specifically in that space. We own companies in Indonesia and Brazil that are taking advantage of that. But really, technology has really become a really large part of the emerging markets, and that's an area that is still growing and will continue to grow over the next decade.
And the other thing I wanted to mention is, when you moved out to Malaysia, we built out a part of our research team. So we're actually able to leverage the kind of the feet on the ground out of our Malaysia office to look for opportunities that we built out that didn't exist when we launched the fund, in 2009. So that's been an asset for our clients to just have that on the ground research team in Malaysia. Yeah,
and then the other thing to keep in mind is I'll give you 2 examples. A lot of people think that emerging markets, for example, companies in Malaysia, you're only getting taking advantage of either that country or just that region. However, to give you an idea, Malaysia is the largest manufacturer of rubber gloves in the world. And so the two or three of the largest companies are actually domiciled in Malaysia, traded in Malaysia. But their shipments, majority of it going to the developed world in the US. If you go to a doctor's office, more times than not, those rubber gloves that the doctor is using are going to be coming from Malaysia. The other thing, another example I can give you is not the largest, but one of the largest chocolatiers in the world, Godiva, is actually owned by a Turkish company. And so, in order, when I was in the US, in Malaysia, I used to tell people, you have to have access to the developed world because you're using products that are not manufactured or not even, not manufactured here. So how do you take advantage of that? You have to invest in the US and in the developed world. In the US, I would flip that around. I would say now more and more than ever, there are products that you're using, even in your iPhone, that are coming from the emerging markets. And in order to be able to have exposure to that, to be able to take advantage of those, you have to have some exposure into the emerging markets and to the Amana Developing World Fund.
There you go. Very, very good. And thank you for this webinar. Thank you for your comments. And Gus will reach out to the attendees. Make sure you have a copy of our impact report, a copy of the slides. And if you have any questions, feel free to get a hold of us. So thank you very much. Thank you, Levi. Thank you, Manim.
Thank you so much.
Thank you. It was a
Take
pleasure.
care.
Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information about Amana mutual funds and a current prospectus or summary prospectus, please visit amanafunds.com or call toll-free 1-800-728-8762. Please read the prospectus or summary prospectus carefully before investing.